So here we are. Last class wasn't posted, Chris, so we shall be able to ensure it's posted. It has to be posted. It must be posted. It must be posted, yes. It must be posted. All right. So now the session is being recorded and we're starting right away. Yeah, it's being recorded. Great. So then remember, there is a handout that I gave you, right? The notes which we shall be using here throughout. Have you been able to share those notes with the new students? Great. Have you added them to our WhatsApp group? So remember, we started by mentioning, if you can recall very well, that the company to be restructured is really a company that is not doing very well. We restructure companies that are financially struggling. Remember, there are so many companies in Kenya here that are financially struggling. And I gave you a very good example like Mumias. Yeah. So Mumias, in this case here in Western region, is a huge company, but on its knees. So as a finance manager, you could be called upon to restructure it. So in terms of restructuring it, you could look at, for example, and ask yourself, what is really troubling this organization? It could be huge debt. So if it's huge debt, call the banks which gave you this debt, these loans, and tell this bank, you know what, we can't manage to pay you. So instead of giving you cash, why don't you take our equity instruments? Why can't you accept our shares in lieu of your loan payment? So basically, then you will be able to do what we call a financial structure, where you do what we call a debt equity swap. Debt equity swap. These are the kind of things we shall be looking at. But you see, before you start restructuring an organization, it will be very important for you, first of all, to measure, or what we call predict. Yeah, levels of what your financial distress. You must, in this case here, be able to measure or predict these levels of financial distress, of which, as a quick way of recalling what we did in our last class, the very first prediction model that we looked at in this particular case is called what here? Yes, Altman's who? Z-score. It's called Altman Z-score model, of which I gave you an acronym. Are you able to remember that acronym that I gave you in class here? Because here we need 5 ratios, isn't it? We need 5 ratios. Remember, Altman's Z-score makes use of 5 ratios to predict corporate failure. And those 5 ratios, we said, hey, we shall be using this concept of water mass to remember the 5 ratios, where WO and the MA, these are the only ones which come in doubles. All the others in this case here are singles. For us to get the 5 ratios, 1, 2, 3, 4, 5. And if you remember very well, we said WO is X1. Yeah. And then we said in this case here, R is what here, somebody? X2. E in this case here gave us what here? X3. And then we have MA giving us X4. And then we have S giving us what here, somebody? Now, once I have these initials, it will be very easy for me to remember what they stand for. Is there somebody who is able to remember what WO stands for? The working capital, isn't it? So this WO stands for working capital. Thank you so much. Don't write anything because this is just a recap. How about this R? The online ninjas, I can't see you writing anything there. R in this case here, the online ninja stands for what? Retained earnings, isn't it? So this R stands for retained earnings. This stands for retained earnings. And then this E stands for what here, somebody? EBIT, which is earnings before interest and tax, yes. And then how about this MA? Market value of shares, yes. Not just any shares, but ordinary. Maybe I forgot this. It should be market value of what here, somebody? Ordinary shares. Market value of ordinary shares. And then we have lastly SA, which stands for what here? Sales. But now again, remember that these are supposed to be converted to ratios. So how do we convert them to ratios? Everything. to show how important tata is, isn't it? Yeah, you divide everything by ta, 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 like that. Except which one here, somebody? X4. Where we shall be able to divide by what here, somebody? TL, isn't it? TL, yes. What does this star stand for? Total assets, isn't it? Total assets, yes. And then we have in this case here TL standing for what here, somebody? Total liabilities. I don't want to do any question on this area. So I want to go to the second model of measuring bankruptcy, which your examiner really, really loves. Your examiner loves this second model a lot. Your examiner loves this second model a lot. So the second model is what we call, yeah. Can you kindly pronounce this for me? Springate, yes, not Springate. Springate model. Springate model. So under Springate model, ladies and gentlemen, what are we supposed to be knowing under this Springate model? Under the Springate model, what are we supposed to be knowing? Don't even open your handout. You can just listen what I'm going to mention. Ladies and gentlemen, here, this is nothing much under Springate. Springate makes use of how many ratios? There are 4. Springate makes use of 4 ratios to predict bankruptcy of a company, to predict corporate failure. So it's a financial distress prediction tool that uses 4 key financial ratios. It uses 4 key financial ratios. And the most important thing for you to see how those ratios are being used is for us to look at a past paper question, which I called upon you to search for August 2025, question number 5A. August 2025, question number 5A. Do you have it? Have you been able to get it? It's called Tola Limited. Tola Limited. It's called Tola Limited. Tola Limited, you could easily share. Tola Limited, the online guys today, they are not talking to me so much. Have they been able to get the question? Our neighbor at the back, I don't know whether she has gotten it. Please add every new student to this class. It's very, very important. So Springate. So you're told here the following statement of financial position and the statement of profit or loss relates to Tola Limited for the year ended like that. So they've given us a statement of financial position, which is our balance sheet, right? And then, ladies and gentlemen, down there we have our statement of profit or loss, which is our income statement that you can easily see there. The company's ordinary shares are currently priced at how much here? 4 per share. 4 per share. Then they want us to use Springate model, assess the financial health of the company. And they're giving us how many marks? 6 marks. Those are marks that can make you see play that you've never seen before. Places that you've never seen before. So the good thing with these models, your examiner will always give you the formulas. I even don't know why students fail in AFM. Your examiner, you can see down there, he has given you note. The Springate model takes the following form. Are you able to see Z equals? And then he goes ahead to tell you how you will calculate A, B, C, and what here? D. So if you're keen enough, you'll be able to pick all these marks here. If you're keen enough, you shall be able to pick all these marks here. So first of all, we shall write the formula given by the examiner. He has told us Springate's Z, don't cram the formula because this shall always be given to you. Yours is to know how to calculate the ratios and how to plug them in. So we have 1.03A plus 3.07B plus 0.66C, isn't it? Yeah, plus 0.4D, isn't it? 0.4D, you're right. And then now we are going to compute the 4 ratios, A to D. We start with A. Has this ninja of an examiner given us the formula for getting A? He has told us we take, in this case here, working capital over what here, somebody? Working capital, yeah, same. Working capital over what here, somebody? Total assets, over total assets like that. So then I would want to remain a little bit silent to see whether you guys will be able to get these numbers from the balance sheet. From the balance sheet. Shall they be able to get these numbers from the balance sheet by themselves? And then we get to substitute here. Neighbor to attend. Okay. Oh, Smite is saying tata liter. Okay. Tata liter. Okay. Great. That is very interesting. I'll be able to use it in my next semester now. Great. Great. So then we start with the working capital. Do you remember the formula of getting working capital? It's current assets minus current liabilities. Current assets minus current liabilities. So from the balance sheet given, in the balance sheet, which is the same as statement of financial position, are you able to see on the asset section? Are you able to see the total current assets? Yeah. So in this case here, we are getting working capital. So working capital is current assets minus current liabilities. Current assets, I can see 740,000. Go to the liability section. What are you able to see as the total current liabilities? 600,000. 600,000. So this gives me a cool 140,000, isn't it? So then this is 140,000 all over. Go to the section of assets and please combine all your assets to give me total assets. So are you able to see the total assets without much struggle? It is 21 what here, somebody? 40,000. 21, 40,000. So abracadabra, could you kindly give me the value of A? 4 decimal places, right? 4 decimal places always. 0.06, 0.0654, 0.0654. So that is A. So now we should be able to go ahead and get B by ourselves because the examiner has guided us on what we need to do to get the value of B. The examiner has guided us on what we need to do to get the value of B. The examiner will always guide you. AFM examiners are gracious. They're nice. They're nice. So if you look at the past paper, ladies and gentlemen, they have told us what we need to do to get the coefficient ratio B. They have told us to take operating profit over what here? Total assets. Can I rub this? I can rub, Thank you so much. So in this case here, let's go ahead and get the value of boy. The value of boy. And you don't cram these at all. Never cram these at all. Boy, they have told us we take operating profit all over total assets. Do you know the other name of operating profit? It is untaxed. EBIT. EBIT. So this will be the same as EBIT over total assets. So then from the income statement now, are you able to see the EBIT? My online students today, they are not really themselves. I don't know why. I don't know whether they got the link to this class very late. You see, this is EBT. I want earnings before interest and tax, which is how much? 150,000. So it will be 150,000 divided by the same total assets, which you guys had given me, isn't it? They were 21 what year? 2140,000. They were 2140,000. They were 2140,000. So then at the end of the day, 4 decimal places, what are we getting there? Okay, let me see whether online guys are getting these numbers. I don't want to be accused of moving very fast. I would want us to move in this case here on the very, very same wavelength, same pace. 0.0701. So I'm being told that this is 0.0701 like that. Is it just 0.0701? Thanks, Joanne. Thanks, Madam Sue. Thanks, Sam. Thanks, Deno. Thanks, Milton. Great. Then go ahead and give me the value of cow. C. They've already given us the formula for getting this C. What have they told us is the formula for getting this C? Ladies and gentlemen, what they're telling us that we should be able to do to get C, they have told us it is profit before tax, all over what here, somebody? Current liabilities. Profit before tax, all over current liabilities. So C is profit before tax, all over current who? Liabilities. All over current liabilities. So is there somebody who is able to see the profit before taxation from the income statement given? Aha. The online ninjas. 40,000, right? 40,000. The online ninjas today, they are okay. So we have here 40,000. Divide this by the current liabilities that you guys had given me some time back. 600,000? 600,000. 600,000. Which then will end up giving us what figure? Karibu sana. So our cow, I'm getting an answer from Olango Francis from Hybrid, who is the student who is calling themselves a hybrid here. So C is 0.0, 667. 667. That is our C. And then, ladies and gentlemen, we go to the very last one. So but first of all, before I continue, are we together, all of us, up to this place where Mwalimu has reached? You haven't yet reached there, especially the online guys, because some of you, I know you struggle because of internet. There is that lag. They're saying no. Somebody is saying no. Joshua, where have I lost you, Joshua, my namesake? Where is the problem, Joshua? Have you just joined now? If you don't mind, Joshua, just mention there. Or just joined. Don't worry, Joshua, then I'll be able to, of course, number one, at RCM, we'll be able to get access to this video immediately after our class. And then number two, once you watch the video, if you get a problem, you'll be able to ask a question, because I can't start from the very beginning. But I can assure you, don't leave the lesson, because I'm almost finishing this model. By the time I start the third model, you'll be okay with the third model. Great. So then we go to the last one, which is dog. Let's go to dog. So dog, have they given us the formula for getting D, dog? They have told that as it is what divided by what? It is sales over total assets. So where do we get our sales from? From our income statement. And are you able to see the income statement? Sales is how much? 600,000. 600,000. All over what here, somebody? 2140,000, isn't it? Which gave you guys what figure of dog? 0.2804, like that. So now we have been able to get all the figures of A, B, C, and D like that. Then now our work will be to substitute here. So go ahead and substitute. Go ahead and substitute. So we have our Z ratio being equal to 1.03A. A already we have it, 0.0654. Yeah, plus 3.07 boy. Boy, we know boy, 0.0701 plus, the formula is given here, 0.66C, and then our C is 0.0667 plus D, 0.4D, 0.2804. Let me know the figure that we are getting. So remember, once you get the values of A, B, C, D, you must plug them in. The Z equation given. Yeah, Z equation will be given. Z equation will be given. Let me see what these great students of mine are getting. the final answer, which is our Z, 0.433. What are the online ninjas getting? Let me see the online ninjas. What are they able to get? You got a different one. The same. 0.4386 or 88. No worries. You know, 4 decimal places, even if you miss it out here, you can't be wrong. Because this is a very tiny difference. 0.4387. 0.4, then is saying 0.4388. 0.4388 is popular, right? Okay. But even if you leave it at 86, trust you me, nobody can ever give you a wrong. So now from there, we make a decision. And at this point of making a decision, I gave you the Altman's Z-score threshold numbers. Let me see who is able to remember. Yeah, and today I have money. Who is able to remember the Altman's threshold numbers for making decisions? That number line. Yes. 1.8 and 3. Huyu mzee ndiye amesema kwanza atakula 1000. Na Joshua pia amesema, so 1000 for this ninja here physically, 1000 for what here? For the online ninja as well. Yeah. So when it comes to, in this case here, this particular model, in this case here called Springate. So for Springate, the decision is like this. We normally use 0.86 what here? 2. And you must, unfortunately now this number, you must cram it. Unfortunately, you must cram that number. So this is a number line. This is the only thing you cram. They give you every other thing, and then you have to cram this. Such that if you forget it, you'll still have earned so many marks. So very many marks here. So 0.862 is the threshold number. That if your company falls here, it means that the company is bankrupt. If it falls here, below 0.862, your company is bankrupt. And if, of course, you fall now on this other zone, it means that your company is what here now? Successful. It's a good company. It is a liquid company. It is a solvent company. So 0.862, you have to cram this one here under Springate. The Springate number line. Springate number line. So then talk to me something small about Tola Company Limited. Springate number line. So what do you think of Tola, given that you have gotten its Z being 0.43? It's bankrupt, isn't it? Because this number is less than 0.8 what here, somebody? 62. Therefore, Tola is what here? Bankrupt. It needs a lot of restructuring. The company is bankrupt. The company is bankrupt. All right. So I'll only do one question, and then I'll give you one question on this area as an assignment. But I haven't seen any assignment that has been done by yourselves of management accounting that I gave you yesterday. Because you're supposed to do, and then you send your answers where? On WhatsApp, isn't it? Online ninjas, is there anybody who I'm normally very, very keen on those WhatsApp groups, especially on assignments that you do. Isikue kama last semester mwanafunzi ananipigia after exam ati mwalimu mbona hukutuambia inakuja, hata mimi sijui kama ilikuwa inaku. Mimi nawapatia tu kibahati tu. Unakosa kufanya, wenzako anakuambia mwalimu hii imekuwa tested. Unashangaa. So nitawapatia hii homework before the class ends and the homeworks are supposed to be done immediately. Hata ukienda home unatoa kalamu na karatasi unaandika mahali. Kwanza wala kwa physical hapo unamaliza kabla kwenda nyumbani. Sawa. Ufalme wa mbinguni ni ya watoto wadogo. Unajifanya mtoto mdogo, umalize hii maneno isikupata. There is a new syllabus coming in 2027. Are you aware of the new syllabus? Yeah, we have a new syllabus coming in 2027. And one of the saddest thing, just like ACCA, how they did with ACCA, they took all their exams online. That's what they want to do with CASNEB. All exams now will be online. So if it is this financial management, you'll be saying Springate, all those ratios, you are typing them in Excel. It's going to be crazy. When ACCA introduced computer classes, computer exams, the numbers here dropped down by about 80% in Africa because Africans typing is a problem. If, for example, in these exams that you guys are doing, some of you normally sweat from the wrong places, right? And you are writing, get somebody and sweat hapa kwa dhidhi. Unajua sweat kwingine mtu ataona, lakini hapa kwa dhidhi hapa ni hatari. So you can now imagine what will be happening in this case ukitype. Itakuwa international disaster. So the very best is to ensure that you clear all your papers before December 2026, all of them. And you have the capacity, really. You have the capacity. We are here to support you. Thank you so much, Olango Francis. I must finish CPA this year. Yeah, I must finish CPA. Amen. Yeah, we must finish this thing this year. It's tupate. Now, then we have what we call 𝐹𝐺 model. Now, from your notes, we have the 𝐹𝐺 model. From the notes that you guys were to print, you must have forgotten, Yeah, 𝐹𝐺 model, this has never been tested. They can only test the theory part of it, And if they were to test it, they will give us the formulas, so there is no problem. So 𝐹𝐺 model, they are saying they are developed by 𝐹𝐺 in 1984. The model predicts financial distress using multiple discriminant analysis based on 9 financial ratios. 9 of them. The model was derived from a study of small and medium-sized manufacturing firms, 60 failed and 60 successful. It provides a single known as 𝐹𝐺 H-score, which indicates the probability of financial failure. And the formula is given there. Just in case they bring it in our exam, the formula will be given. You can see a formula there. And they're even and they shall also be able to explain these ratios for you. They are telling you X1 is retained earnings over total assets, blah, blah, blah. So we shall not be able to talk about this, but just in case they bring, which they have never, all the years I've taught AFM for 25 years, they don't bring this thing totally. They don't bring this thing totally. Here they normally use 0 as the benchmark value. So if whatever number you get as H is positive, more than 0, it means that the company is successful. And if you get a negative value, then it means that the company is financially distressed. So 𝐹𝐺 model, we shall not waste our time there. The only thing you need to know theoretically is that 𝐹𝐺 model is a quantitative model of measuring financial distress, measuring what we call corporate failure, which uses how many ratios? 9. Once you remember that, that is it. They have never tested us. In case they test us this semester, then I shall be seriously teaching next semester students, because you guys will have passed, isn't it? No, they can't bring it, so long as you just remember that theoretical background. That is just enough. Which then takes me to the, yes. Yeah, and it's what we are doing. Like now we have said we have 𝐹𝐺. Then we have another model known as what here, Altman's, isn't it? Yeah, once I finish tackling all the models, then you will be able to do what here to answer part 2. Thank you for that question. All right. Yeah, please feel free always to ask questions there. So advantages of 𝐹𝐺 model, it's really comprehensive. You can see it has many, many ratios in comparison to the other models. It's very comprehensive. It includes profitability, liquidity, leverage, efficiency ratios. It's very comprehensive. Yes. Oh, the page. International design, page number 51, isn't it? Sorry for that. But have you given them the handout? You have added them to the group, right? All right. So it is quantitative. We are using numbers. All right. It is quantitative in nature, and any model which is quantitative is objective. Objectivity means what here that if you give, for example, like if you give somebody like the sprint gate question that you have done, all of us in this case here were getting the same answer. Some of us are based in Nairobi. There must be somebody who is in Turkana County, isn't it? Somebody must be in Southern Sudan, Rwanda. So objectivity in this case here means what here that we are able to get what here they say Same answers here. As opposed to models which are what here subject. You see, subjective are qualitative. Qualitative models in this case here, if you give two accountants here to assign scores, they are going to assign different scores. This is quantitative, so it's very objective. It's very objective. It's quantitative, and therefore it's very objective. Then predictive, useful for early detection of financial what here trouble. We are able to use this model to predict the future. We are able to know from today how is the RCM doing in terms of solvency. Practical for auditors and bankers for risk scoring. Yeah, we normally use it for risk scoring. How about limitations? It is industry specific. Ladies and gentlemen, these models you are seeing us talking about here, be it Altman's model, be it the Springate model, the Falmer model, most of them in this case here are useful whenever it comes to prediction of corporate failure for manufacturing firms. Not service companies like, for example, RCM, which is offering what here? Service. Manufacturing firms, industry specific. Then now remember, we are making use of a balance sheet. We are making use of what here? Income statement. We are making use of financial statements, which are historical. The history could look very, very nice. I mean, ladies and gentlemen, most of you in this case, of course, are very, very young. There are big companies in the past that you could not imagine that at any given time they would die. Look at Nakumat. You know, Nakumat sometime, just the other day, they used to tell us that if you need it, today if you go to, do they have any branch, by the way? Even if they had there, if you went there, what you'll get is the dust on the shelves, isn't it? Yeah. Look at Akamba. Did you get to see Akamba? It used to be a big, sure. I doubt, Marion, I doubt. Akamba used to move all over East Africa, isn't it? Huge company. Look at Uchumi. So what you're saying, because you're making use of these financial ratios, financial statements, you could easily be cheated that you are doing very, very well. But at the end of the day, in the near future here, we do what we call we collapse. That history, the historical, something can come like COVID-19. You've been doing very well, but COVID-19 comes and it buries you as a company. So whenever you're asked about advantages, disadvantages of those quantitative models, always remember, I'm now using this as a very good example to cover all of them. Very good. Static model. It ignores qualitative factors like what your management competence. I'll be able to cover these qualitative factors in the next model, and we'll be able to understand how important qualitative factors are. Qualitative factors. And remember, especially for the students who are combining advanced MA and the advanced FM, which is really good. And advanced MA, we said that any organization, regardless of how well it is doing, it's always important for it to look at its operations from 4 perspectives. 4 perspectives. So we said, number 1, you look at your finances, isn't it? I know most of you are not doing this. So we have your financial perspective, which really is just one quadrant, which talks about money, revenues, costs. All these other quadrants here are what your quality. And that is why, because of even their size, qualitative parameters are more important than this monetary. So then we have in this case here the customer perspective. Yeah, you can't measure customer satisfactions, for example, but customer satisfaction, qualitative, yes, but very important. If today you get billions today, and these guys are not satisfied, tomorrow they'll disappear, all of them. Yeah, customer perspective. We also said you must have what we call the business processes perspective. Yeah, very, very important. If you have internal controls, proper processes, then the company will be there in the long term. Then we have what we call what you're learning and what you're learning and innovation. Ladies and gentlemen, remember, in life, money is never everything. There are these young girls I normally see, they normally keep on saying that they would rather cry inside a Mercedes Benz. Meaning that money is the most important factor, is it? Sure, money is the most important factor. No, you would rather some qualitative factors like respect, isn't it? So if this guy, fine, he has Mercedes Benzes and whatever, but he normally comes home at 2 a.m. and then he tells you start cooking from scratch. And then remember, you're a working lady who has to wake up at around what you see? Do you want to tell me you would want to be crying every day in that Mercedes Benz? Yes, and then you guys are crazy. You guys, then you So qualitative factors are those factors that you cannot quantify in terms of money, but they are very important. For example, getting married to somebody who is saved, even if he doesn't have money, is that not good? So, so for salvation, I mean, we shall overcome, right? We shall overcome. Yeah. So static model, it ignores qualitative factors like management competence. Management competence. So remember, ladies and gentlemen, in terms of my illustration that I normally give you every other day, which is very, very important, and I would want to repeat here. And by the way, most of you guys online have never seen your cameras. Are you able to put your face, I mean, are you able to put your cameras on? So today I can get to see you. It doesn't matter, I mean, just start your video. Today I want to see you. Today I want to see you. Like I can see Ben Robbie. I can see Dennis Dombi, and I've seen him some time back. Ah, great. I can see Rachel. Great. So all of you, can you kindly touch your chin? Please touch your chin. Yeah, very good. All of you, please touch your chin. Do you know that the chin is this one? Are you aware that the chin is this one? Are you aware that chin is this one? Why did you go wrong? And you guys knew very well. Why did you go wrong? It's because here, I'm your team captain. I'm the manager here. And if the manager makes it wrong, I mean, I say touch the chin and I touch the wrong thing. So the same case with these companies. It doesn't matter how beautiful they are. It doesn't matter how liquid they are. If you get wrong management that is setting the wrong tone at the top, that company will collapse, yes. Wrong management, wrong management. Thank you so much. Now, having gotten it wrong, please put off your cameras. Put off your cameras now. Thank you so much. All right, okay. All right. Yeah, so dependent on accounting policies, differences in valuation affect what year results, meaning that, ladies and gentlemen, because basically we are relying on financial statements, of course, can be used to do what we call window dressing. Window dressing is what we also call what here, somebody? Creative accounting, isn't it? Creative accounting, where basically you'll be able to use your financial statements and then you create fake profits. So it means that even these particular models here, Altman, Z-score, Springate, Farmer model, because they are making use of what here, these financial statements here that are creatures of window dressing. You know how you can dress your window very well with very good curtains, but inside, there is nothing inside the house. Yeah, the same case, we normally see so many people. So people come in this case here, and then they tell us from nowhere that Kenya Airways now started making profits. Most likely those profits are being created 6 months down the line, when they do their half-year results, again, they're getting into losses in terms of what? Yeah, billions. So that's how we talk about windows being dressed nicely. So if you dress those windows nicely, it means that also these other predictive models of financial distress will be giving us wrong answers. They are subject of manipulations. Very, very good. Now, ladies and gentlemen, from there, we move on to the next model, which is very, very popular with your examiner, the last one, Argentis score model. Argentis score model. Now, as you get into this particular page of Argentis score model, not yesterday, the day before yesterday, when we had AFM, I asked you to go to your company and calculate your Altman Z-score. Altman Z-score. Were you able to calculate your company's Altman Z-score? Is there anybody who did that homework? So please, if you can, ensure that later on you get your financial statements, especially if you are in a manufacturing sector, isn't it? Service sector, that model will not apply. So in manufacturing sector, go ahead and compute for us the Altman Z-score and the Springate Z. Don't forget, that is really, really important. So this Argentis score, we shall be able to do it with you here for your company live here. And then you take the results to your directors tomorrow, right? You don't sugarcoat things. Tell them the truth. They can't fire you. We're going to do this number here today. If it shows that you're bankrupt, tell them this company is bankrupt. Developed by John Argenti in 1976, before some of you were born. This model identifies non-financial. So this is qualitative, non-financial and managerial weaknesses that lead to corporate failure. Unlike pharma, it is qualitative and diagnostic in nature, focusing on why a company fails, not just whether it will fail, why it fails. Agenti argued that failure is a process, not an event, beginning with poor management decisions and control weaknesses. Beginning with poor management decisions and control weaknesses. Structure of the A scores model. The model assigns failure points under three main categories. We have defects, management weaknesses. Then we have mistakes, strategic and operational errors. Then now we have the symptoms, glaring symptoms, financial or performance outcomes. Let's discuss each one of them at a time. We start with the defects. Defects are what they've called what here, somebody? Management weaknesses. Management weaknesses, we are looking at corporate governance. Very many companies, ladies and gentlemen, are not being governed very well in accordance to the corporate governance charter. You will get a big company without what here? A board of directors here, without a board. Yeah, no board. This is a management weakness. All right. Or you get, in this case, ladies and gentlemen, a company that has got a board here, which in this case, at the end of the day, has one individual who is too powerful. One individual who is too powerful. Do you know how they make lots of powers for themselves? It's very easy. You get, I normally laugh at them every day. When I go, in this case, here to my golf club, I play golf a little bit. So I get somebody giving me their business cards, and they are saying that they are the chairman, and what here somebody? CEO. Is this recommended? Really? No. You're supposed to be, one of them at a time, isn't it? Chairman runs what here? The board. And the CEO is the one who oversees the day-to-day operations of the business here. The moment you tell me that you're the chairman, founder, and the CEO, international disaster. Because, ladies and gentlemen, especially for government entities, even all of us, ladies and gentlemen, like the other day I was reading something that about 65% of Kenyans go to their workplaces every morning with an intention of stealing. Look at this number, staggering. And then you can imagine one individual who is very powerful. Nobody in this case will be able to check, no checks and balances. If this gentleman is this powerful, chances are they will automatically misappropriate assets of the company. We need checks and balances across. Like if it is board of the board, the directors of the company, these people are not supposed to be having day-to-day activities in the company. It is only in Africa where you will get like the chairman of the board has an office in the company. Like the chairman of IBC. It's like he's a full-time employee. You can't get those things outside there. If you look at companies that are doing very well in terms of corporate governance, like who is the CEO of Equity Bank? James Mwangi, isn't it? That one we know, isn't it? Who is the chairman of Equity Bank? Most of us in this case will not be knowing, isn't it? It's supposed to be like that. Chairman should always take back seat because chairman, your portfolio is very, very little, very small. The chairman's role is to manage what here? The board. Yeah. And then the CEO now does everything. You're like even the spokesperson of what the company like that. So the moment you realize there are so many defects within the management, even controls are not there, then automatically, according to Agenti, this company is going to struggle financially. Yeah. It shall struggle financially. All right. Great. I'm being told here that the chair of multimedia, he likes working a lot. Is there on a daily basis? I wish I can talk to him. The chairman is not supposed to be having an office in a company. That's very, very wrong. That thing you hear like Wafula Chebukati is talking all over. No. The chairman is supposed to manage the board. The board, you make resolutions, and then now the chairman, you liaise with the CEO to run those resolutions and agendas on behalf of the board. Very good questions there, Sam. But I believe this now shall be able to go to your teachers of leadership and management, because you'll be able to cover all this great stuff under leadership and management. Difference between a CEO and a director. But basically, director, you can be a director by just investing. You've put in your money, but you're not in the company totally. Now, each factor we are told carries a weighted score. The total A score determines failure likelihood. So let's see our company now here. Let's see our company, my good students here. So we have here defects. So I want you to listen very slowly here. So defects number one, examples, poor management. In terms of managers being incompetent, they lack depth of even management. They are autocratic, meaning that they are dictators, like Museveni. Yeah. Then we have weak financial controls, lack of management accounting systems, like now there are no budgets, poor response to change. So please think about your own company and give it a score out of 45. If you believe in this case here that your CEO is autocratic, you don't have internal control systems. You are not, you're running this company without without budgets. These people are not even listening to the accountant. The accountant is there just like a flower girl. Please go and give that company a big 45 over 45. Please. So in terms of defects, I want everybody to rank their company. If the company has got so much defects, give it 45 or 45. If it's 50-50, for example, you believe that my CEO is autocratic, he's a dictator, but not too much. At times he listens. You give us 20 out of, you'll be able to, I want everybody to rank their company, rank your company. Please take time and rank your companies. Rank your company. So out of 45, in terms of defects, how many marks are you giving it? And be very, very honest. Be very, very honest. Mistakes. No, first of all, I want you to rank in terms of defects. How many marks are you giving? If your company, ladies and gentlemen, has got very good managers who love their work, they show depth of knowledge in terms of how the company is being run, give it 0. It's not defective at all. It's not defective at all. Give it 0. Think about your company, and I hope everybody is working, right? Don't tell me you're not working. I'm giving you 3 minutes. Think. So we are scoring our companies. If you're not working, you can also score Kenya, isn't it? You can score a country if you're not working, isn't it? 45, what do you mean? Now, ladies and gentlemen, if we have a problem with management, if we have managers who don't have the depth and the love of the company, they shall get us into trouble. So we shall be able now to start straight away seeing those mistakes happening. And the mistakes, basically, the kind of mistakes we shall see, just like we saw with the 𝐑𝐂𝐿, are which mistakes here? Number one, over trading. So you start seeing them all over. Whenever they saw any mall, they went into this mall as an anchor tenant, isn't it? And of course, over trading means that you are growing very fast, more than your resources can cope up with, isn't it? You'll be able to get into what we call thin capital. For those of you who are doing taxation, thin capitalization. All right. You start investing all your assets, Yeah, including short-term assets into these new branches like that. So you start over trading, and then the other mistake that will obviously happen now because of this, it will be high leverage, high gearing. You start doing what here? Somebody overborrowing. So you can see, ladies and gentlemen, there, those mistakes there. Please give your company, of course, your accountant, especially if your company is always on a overdraft. If your company is always on overdraft, that's a big mistake. Give it 30/30. If this company has those issues, they're expanding without adequate capital, high gearing, large acquisition mistakes, over investment in unprofitable projects. If you think those mistakes, give it 30/30 or 20/30. Now, ladies and gentlemen, if they make mistakes, they can't cover up bad things forever. After some time, now symptoms will come out. They'll be glaring. Unameza dawa kidogo, lakini afika time symptoms taonekana. All right. So these symptoms are deteriorating liquidity, declining profitability every other year. Profit is going down and down. High staff turnover, like you get the CEO resigning. That's very, very bad. Like now in EABL, we have this great lady, RISPA, CFO. She has just resigned. Of course, EABL is still a very, very strong company, but you know, there are positions, ladies and gentlemen, that you don't expect to see anybody resign. How do you resign from a position where you are getting like 5 million a month? And you see now these people are the ones who are at the helm. Automatically, the moment they start sensing danger, they start, in this case, here doing what here? Resigning, isn't it? Yeah. So then that one, please give us a score. Give us a score. Out of how many marks? Give us a score. Of course, you know, 25. If you are doing very poorly on that ground, give us 25 out of 25. And then I'll add up everything. So like if it is Kenya, you know, you can cheat people, not forever, isn't it? Things will start, in this case here, showing up. I'm not saying that our president is a liar, but I mean, things happen, isn't it? Yeah. You'll start hearing that, for example, Rwanda is growing double digit, 11, 12%. Kenya is still at below 5%. So deteriorating liquidity, declining profitability, high staff turnover, qualified audit opinion. If you got a qualified audit opinion the other day, please put yourself there at 25/25. So please add up all your marks, and then we get to see out of 100, where are you as a company? Is there a company which is getting 100/100? We shall overcome, isn't it? So if in this case here, you got your total being 0 to 25, then your company is very healthy. If the total that you got lies in between 0 to 25, your company is very healthy. 26 to 35, those are early warning signs. We need to monitor closely. 36 to 50, financial distress is now coming. Anything over 50%, ladies and gentlemen, is corporate failure. Corporate failure. So companies zenu ziko wapi? Hata mjaniambia. Companies zenu ziko wapi? Very healthy, eh? Wow. WhatsApp group, okay. Audio lost. We are back. We are back. Now, nobody will ask you to make any scores in your exam. The only thing you'll be required to remember, ladies and gentlemen, are those 3 steps of this person's model. The agent is a score model. Those three particular, do you remember them? Of corporate failure. Number 1, we start with defects. Number 2, mistakes. And then lastly, symptoms. And then you remember that agent is a score model is the only qualitative model. Is the only qualitative model, which in this case is using non-monetary factors. Non-monetary factors to predict corporate failure. It uses non-monetary factors. Non-monetary factors to predict what year? Non-monetary factors to predict corporate failure. And the failure basically goes through 3 key steps. It will be very, very important for us to remember those 3 key steps. Defects. We have mistakes. And then lastly, we have what here? Symptoms like that. Yeah. Defects. So even human beings, you can easily use, ladies and gentlemen, this model very easily to predict your future. Sasa unapata jamaa mzee kama Rikango, unajua mdogo at least, lakini Rikango anacheza kamari. Ni kamari ameitwa namna gani kitu betting. Hiyo si international disaster. Hata mdogo si international disaster. Unacheza kamari ya kazi gani? Kidogo kidogo itaanza kuingia hapa kwa mistakes, mambo ya kukopa sasa branch everywhere, isn't it? Mpaka ingine inapigia pasta yako simu. Kutoka hapo inakuwa symptoms. Unaweza kuona jamaa ameanza kupelekwa mtu wa Rikango, ameanza kupelekwa rehabilitation. Yeah, so even as a great human being, you can easily measure your direction given what you are doing. All right. Now then we shall be able to go back, ladies and gentlemen. Yeah, somebody is saying there is a company known as Menya, which was given 99 out of 100. Will that company survive next year? Yeah, 60, 55. How about ultimate Z-score? That we did yesterday. Now, ladies and gentlemen, with your permission, I will be able to go back to which page now? Very fast. Now we have finished this topic, but there are things that I cannot allow you to go and read on your own. If I allow you to read them on your own, I will be in problems when they bring these exams. Ideally, I would have asked you to read on your own, but we move back a little bit, just a little bit, to the very beginning of this chapter. The very beginning of this chapter. All right. Yeah, from the very beginning. Page number what here? Page number, this will be very good, especially for the students who are joining us here for the very first time. Page number 41. Page number 41, we have what we are calling there chapter 5, restructuring and reorganization. Page number 41, background. Corporate restructuring is the process of reorganizing a company's operations, ownership, or financial structure to improve profitability, efficiency, or adapt to changes in what is somebody? Environment. Now, ladies and gentlemen, remember environmental changes can really, really affect you. Look at, for example, this company called Kodak. Kodak, do you remember Kodak? They used to come to our homes on Sundays, right? They were taking us very good photos. And then, of course, they were returning those photos after how long? Like a week or 2 weeks, or even a month, isn't it? What were they doing with those photos? I don't know. So when in this case here, this digital photography came, the CEO and the management of Kodak came and wrote off. They said that, this is just passing wind. Digital photography. Now, little did they got to know that this was an environmental serious change. In a span of 3 years after Samsung and other cameras, mobile phones were able to bring us very, very good cameras, 3 years, these guys came to some press conference and said, hey, now we are not able to pay any salaries. Now our overheads are way too high. We are closing shop. And our closure of our shop, ladies and gentlemen, and the factory, of course, is not because of any other mistake. It's because we drifted. You know, we have what we call drifting. So the environment is telling you, hey, you go this way, but you are doing the opposite. You are doing the opposite. Look at, for example, this COVID. COVID here. Some of us in this case here, we are creations of what here? COVID. COVID hit so many companies negatively, but like RCM. Like now you can see we are teaching about 100 students and it's week 1. If you look at your WhatsApp group, we have about 300 now AFM. Actually more because of early morning and evening. All right. Now, COVID was telling these colleges here to adopt online, isn't it? But many colleges like Strathmore, even Visions here, these guys went slow. So we were able to take that fast mover advantage. So when you realize that the environment is telling you to do this, and then you do the opposite, then you are drifting. If the environment is telling you that, hey, the government has joined this affordable housing, and you are in a real estate company, don't you think there is a very big risk there? There's a big risk. You need to start divesting. Think otherwise. You need to start restructuring. So whenever we talk of restructuring, we could be restructuring our operations. We could be restructuring, making ourselves lean to be able to adapt to changes. Otherwise, changes will discipline you. This big change disciplines very, very many companies. And there is no company that is so big that can never be affected by what here? These changes. All right. So you're saying there, corporate restructuring is a process of reorganizing a company's operations, ownership, or financial structure to improve profitability, efficiency, or adapt to changes in the environment. It aims to enhance shareholder value, reduce costs, and ensure business survival in dynamic markets. Key types. We have operational restructuring, where we change production, marketing, or management systems. We change our operations. How are we producing? Are we doing production manually? So we go systems way. How are we doing marketing? Is it guerrilla? If it's guerrilla, we say, no, let's go social media. That's a restructuring. Then we have financial restructuring. This is where we change the capital structure. Adjusting capital structure, debt to equity mix. Then we have organizational restructuring, modifying the hierarchy, especially the hierarchy. You will go to some companies we sympathize when we are auditing companies. You know, when you are auditing companies, first of all, we'll go and do an entry meeting. In this entry meeting, we would want to know the company structure for us to be able to know who do we get information from. Remember, audit is all about what here, collection of evidence and using that evidence to form an opinion. And then now you go and you realize somebody has got this kind of what here, a structure. So we have the board, we have the CEO, we have in this case here, director in charge of finance, director in charge of marketing, director in charge of what? Director in charge of sales. And then beneath here we have, they have a structure that resembles the military. You know the military structure? Where we have the commander, the president on top. Then we have in this case here all those big people, brigadier, a lieutenant colonel, colonels, whoever. By the time you reach this smallest man here, the one we call constabulary, a constable, the structure is so, this structure, when it is so big like this, things don't move very well. So we need to restructure this kind of what here. We need to change this kind of structures here. We need to adapt, ladies and gentlemen, structures that are flat, like the Chinese structures. Chinese structures hakuna ukubwa. Hata mkubwa unapata anafanya nini anakuja anapiga plaster kama engineering model. Ya, hapa Kenya ndio international disaster. Kenya international disaster. Unakuta civil engineer Kenya hata umwambie kuja piga plaster hajui. That is why when you are doing your own house, always ensure that you have got a very good foreman. Fundi ule mwenye anasimamia, sio engineer, because the way engineering is taught in Kenya, in Africa actually, we are being taught engineering as if it's a white collar job. Yeah. I don't know whether I've ever told you that I'm a registered civil engineer. I was doing civil engineering, then I did CPA. Sana kulia, CPA. Yeah. Civil engineering na practice kidogo sana. Sipendi sana sababu the only guys who are very, very good kwa civil engineering who are now using it are those guys si tukienda likizo, walikuwa na kwa ile kitu ya kanda ya nini? Ya mkono, isn't it? Ya sawa najifunza namna ile. Lakini unapata sile tunafunza kwa university, where unakuja na mbona unajenga kajumba kanafika hapa unakabomoa tena. Unakwenda kusimamia nyumba ya nani? You see, huyu mtu wa foreman mwenye amezoea sana. Akiangalia koroga, atakwambia koroga simiti hajato. But engineer Kenya hakuna. Mimi mwenyewe siwezi kubali civil engineer anafanya structures. Maybe nitoe nje, isn't it? because ile knowledge yetu ni kidogo sana. Knowledge yetu ya kwanza kuchora machuma namna hii, but in terms of, I was the foreman of these new buildings at KCA, not foreman but clerk of works cow. Unapata Chinese engineer, this guy will come and set example. Kama ni setting of a house, you see a house, when you are setting this house, you must always ensure that these right angles inaingiana using that 3-4-5 method, right? Engineer Chinese ata set nyumba peke yake. Mkenya hakuna, mimi nakwambia hakuna. Only one or two maybe wala walikuwa kienda kufanya kazi ya mkono. Sasa nikitaka kupeleka mtoto wangu shule engineering, maybe nimpeleke ng'ambo, lakini hapa Kenya international disaster. Hakuna. But of course, the skills ambao niko nazo zinaweza kusaidia hata wewe when you are building. I've rescued so many students in the past. Unakuta mwanafunzi anakuja ananiambia, mwalimu, nataka kuchora nyumba, nataka kujenga nyumba. Unamuuliza nataka nyumba ikae namna gani? So nakwambia sasa mimi nataka ati master bedroom juu. Yeah, so vile anapanga master bedroom juu. Anapanga in this case ya nyumba ya wageni si lazima ikuwe chini always, kama ni commercial net. Alafu anasema pia watoto wakae wapi? Unamuuliza unataka kufanya juu peke yako mzee nini? So you get to advise this guy, unamwambia wezi wakiingia for example kwa nyumba. Wezi wakiingia kwa unataka wagonge watoto wako kwanza ama wakugonge wewe? So unakubaliana mara mwisho, nakubali kitu, hakuna haja ya kupeleka nyumba master juu, isn't it? Because a good kama ni watoto, enda na watoto juu, because watoto wa siku hizi ya majenzi, ukienda juu usiku unaweza katoka. Ama that doesn't bother you. So then that one I'm able to advise on so many good things. I'm also very good in terms of what your landscape, because you should be able to do proper landscaping. Unapata tu mtu amekuja tu from nowhere, even positioning of a house. Jamaa kuna 2 acres, maybe Karen. Akiwa anakuja anaweka nyumba katika, inakaa vibaya. So those ones I'm able to help. But for now, let's talk CPA, right? CPA. All right. Yeah. So we have in this case here, organizational restructuring, where we are modifying the hierarchy. Then we have portfolio restructuring, acquiring or disposing of business units to realign what your strategy. Now, ladies and gentlemen, remember, a portfolio is a collection of investments. We shall be doing a topic called portfolio. A portfolio is a collection of what here? A collection of investments here, a collection of assets. When you are doing your investments, you collect, you give us many assets. So basically, you shall never put all your eggs in one basket. And I've seen people making this mistake. You get, in this case here, somebody retiring, they're given like 15 million retirement money. That is at the age of what year? So at the age of 60 years, 15 million, mwanzo ukienda kujenga ati flats, unaingia kwa rile, hii pesa haitatosha. Nona. Mimi ukinipatia 15 million saizi, ingawa the money market fund is not doing very, very well, ukinipatia 15 million, I would rather in this case here, as I think through, first of all, I can take even this amount niweka kwa money market what year? Money market fund. 15 million can give me about 150,000 every month, minimum. Every month, like that. But the most important thing, this money you need to subdivide it, form what we call a portfolio. Invest this in many assets which are making sense. Some of it could go to money market fund. Some of this could go to those particular companies, in this case, that are able, which are promising in future as shares, etc. So when it comes to restructuring, whenever we're restructuring, we could do what we call portfolio reconstruction. So we look at our portfolio of investment. Which investment, which asset is not yielding anything? That one, we dispose it, and of course, take that money elsewhere, like that. That we shall be able to discuss. And these are things you need to really, really know. Ndio naangusha magorofa, Yeah. Inakuwa shida mingi sana. Itakuwa sawa. Indicators or symptoms which will be able to show that we need restructuring as a company. When you realize that your profits in this case here are declined, year 1, 10 million, year 2, 6 million, year 3. When you see your profits going down like that, it's calling for restructuring, or your losses are increasing. Rising debt levels. Yeah, rising debt levels, especially if you are on these short-term loans. That is international water disaster. Inefficient asset utilization. So you realize a big company like Mumias, huge asset portfolio, huge asset base, but those assets are not being used very Very, very well. Then we have low employee morale. Yeah, loss of market share. When you realize competitors are really eating into your position, you need to change things. Frequent management changes or governance issues, negative cash flows are serious, or delayed credit award year pay. That as a creditor comes to the company, you're always telling them that the CFO is not available, that your check has not been sent. When you start making those kind of excuses, know that it is a high time in this case you restructure. Would even make some employees redundant. I mean, discuss with them like that. You reduce your payroll, etc. Talk to your creditors nicely. Yeah. Is there somebody who works for a company that always gives excuses whenever it comes to payment? We shall overcome. That is where accountants are really miss you. Unaambiwa sema hayuko na huko mtu anamuona, isn't it? Mtu anamuona, we shall overcome, right? Causes of financial distress. Yeah, poor management decisions. Once you have poor managers, then that will be the biggest cause. Yeah, especially managers who are thieves. Yeah, over leveraging, issues to do with debt, isn't it? Inefficient operations and cost overruns, decline in demand or technological obsolescence, unfavorable economic or regulatory changes, fraud, misappropriation, or weak internal controls, excessive diversification without strategic focus. This has been tested. August 2024, question number 4A. They asked my students to give forms of financial distress and the solutions. Forms of financial distress and solutions. Most of them were only able to mention forms, but they were not giving us solutions. So for example, we have liquidity distress, where you don't have cash flow, isn't it? Inability to meet short-term obligation. This is the kind of people will be telling creditors that this CFO is not available today. And yet the invoice was honestly written there, clear within 30 days. So possible solution for this, reschedule debt. Talk to these people. Injecting working capital. Ask the owners of the company to buy shares, more shares. Or in this case here, they give us a rights, isn't it? We issue what we call rights issue here. Solvency crisis, remember insolvency is where your total liabilities exceed assets. When your total liabilities are more than your assets, then you are insolvent. So when you realize you are insolvent, total like how KQ was, the very best is to do a debt equity swap or capital reduction. Yeah, capital reduction. Capital reduction, of course, you can't be having huge capital base. You're saying that your share capital is 100 million, and then you have losses, every time losses carried forward of say 80 million. No. Get to your shareholders, tell your shareholders that this loss has to be absorbed here. So they declare capital of what year for them to see that they are underfunding the company. They need to bring in more money. All right. So in this case here, this capital, we could also do what here, reduce them. Or when you are insolvent, instead of you waiting to die, why don't you think of mergers? You see, under mergers, two companies will be coming together. So under a merger, we have company A is insolvent. Company B is as well insolvent. So instead of both of them dying, you can bring them together, bring their assets and their liabilities together. Yeah, employees, of course, some of them will be retrenched, isn't it? Yeah, we're going to use same systems. Yeah, so that's a very good merger. Yeah, a very good form of restructuring. So if it is a merger, when you bring A plus B together, both companies will lose their identities for us to get a rebirth of what here? A new company called C. Is there somebody who is able to give me examples of companies that merged in Kenya here the other day? 𝑁IC? I'm looking at companies that have merged. 𝐿𝐼C-CBA, isn't it? To form 𝐿𝐶BA. So, of course, 𝐿𝐼C must have even advertised. They went and told their creditors, hey, we are no longer there. Yeah. So in this case here, if they come together and then both of them lose their identities to give us a new company, we call that one a merger. How about this one? If A and B were to come together, but it's only B that disappears and A remains, this will be called an acquisition. So A has acquired B. Yeah, let's discuss this. cat and rat, if they were to come together, if they were companies, will this be an acquisition or a merger? If they come together. So I can see so many of my online students are saying acquisition. They have known because one animal must die and the other one becomes big. So it's an acquisition, isn't it? Because you see, for acquisitions, we have, and we're going to do a topic called mergers and acquisitions here. We have what we call predatory. One is eating the other. So in Kenya, do we have a predator that has been eating other companies? Brookside, isn't it? Brookside has been eating so many of these milk companies, smaller ones. So, but of course, it becomes bigger and bigger. Like now in Africa, I'm so sure it could be really, really a big. I've just remembered another one. How about this one? Yeah, we have in this case here when a girl and a boy in the African setup, when they come together and marry, they get married in the African setup. Will that be a merger or an acquisition? Eh? If we are outside there, of course, like when we eat and we are outside there, for example, in Scotland or wherever, the man or the girl will be able to do what their own worship, isn't it? But in Africa, mimi kama kuna mwenye anaonewa in Africa. Ya kama kuna kuonewa ni predatory. So it means that automatically that is what an acquisition. I know girls, you're not happy with that. That's why I can see Joanne saying in capital letters there, a merger. And I can see, ladies and gentlemen, we have in this case here that UDA, 8ANC. So that was an acquisition, isn't it? Yeah, because UDA is still in existence. How about UDA and ODM in the weeks to come? That will be a merger, isn't it? I suppose that will be a merger. So we expect the name to change, isn't it? Or UDA will eat ODM. No. That will be very, very bad. That will be very, very bad. All right. So please, I'm using those great jokes because you'll see in your past papers where they ask you difference between a merger and an acquisition. Then you'll be able to remember my example. So what is the difference? They come together and they lose the idea to form a new company, isn't it? How about in an acquisition? The big one, you can't use the same word to describe. So you say takes over, isn't it? Yeah, so where this big company, you're saying big company, what we call the predator, takes over a smaller company known as what here, somebody? A target company. Yeah, we shall be able to do that, but at least if you get that kind of a question and exam, you'll be able to really shine. We'll be able to shine. But don't use those examples of marriage. Those are just for us, yeah, right? Operational inefficiency. Where our operations are inefficient, we shall be able to see high costs, low productivity. Then in that case, what do we do? Process re-engineering. If our operations are not doing very well, consider also automation. Profitability decline. Whenever profitability is declining, we are making losses. It means revenue is less than cost. So if that happens, then we have to do cost control or even market more, isn't it? Market more. I want us to skip 5.5. We go to financial reconstruction. This one has been tested all over. This financial reconstruction, tested all over. I know why I'm skipping those ones. So financial reconstruction, forms of financial reconstruction, where money is involved. The first one is capital what year? Reduction, where you write off accumulated losses. Debt restructuring, conversion of debt into what year? Equity, or negotiation of terms. And I gave you an example of a company in Kenya that did a debt restructuring. Kenya Airways, isn't it? Kenya Airways, that day they could not be able to pay their syndicated loan. You'll be asked, what is a syndicated loan? What is a syndicated loan? A loan that is huge, which is normally given by many banks. One bank cannot afford to give a syndicated loan. So it's huge. So like now, Kenya Airways was given, by the way, where do they call it KQ and not KA? We shall talk about that. Because of, we shall overcome. So we have in this case here, Absa Bank, Equity Bank, And then we have Stan Chart. Yeah, they were able to come up with lots of money and they advanced KQ this money. After some time, KQ was not able to pay. Yeah, so in this case, what do? They came and told these guys, you know what? This is your debt. We agree. But if we pay you, we shall collapse. So the very best, instead of giving you money, let us give you what? Here, somebody our share? Our share. So they did a debt equity swap. This is a language I would want to see you using in your exam. Debt equity swap. So whenever, camera imekata battery. Oh, what is it? Do I have another battery? This will be operational inefficiency, eh? Wacha nione. Wewe mwanafunzi online, wewe nipatie dakika mbili, wacha wasiwasi. Back, right? Now we are back. Now we are back. Now we are back. Now we are back. Great. Now, okay. Thank you so much. So these forms of, these are very, very common, highly examinable area, forms of financial reconstruction. We have capital reduction. We have debt restructuring. We have issue of what here, somebody? New shares to raise fresh capital. Then we have merger or what here, somebody? Amalgamation, the same word. Combining with what here, stronger firms. Impact on share price, I want to skip this as well because I don't want to do any past paper question because of the time. So I'm marking what I've skipped. Also, I'll skip impact on WACC. Then we go to portfolio, what here, somebody? Reconstruction. Our portfolio, many investments. At times in this case here, we make so many investments and then we get ourselves having a very, very big kind of portfolio, which we can't run. So if that happens, then we have to do what we call unbundling. Have you ever come across this word bundling or a bundle? Kama unga, a bundle of unga. So we bundle, they're together, isn't it? So unbundling is where we split. Yeah. I'll be able to share this, Lavi. Great. This is very, very common in your exams. So methods of unbundling, we have divestment. Divestment is the opposite of what here? Investment. So when you invest, you're injecting money. When you divest, you're selling your asset. You're selling your assets. Opposite. So divestment, selling off non-core business units. So you look at your units, in this case, which is non-core, you sell. Then we have demerger, which is the opposite of merger. Merger had come together, then you realize, in this case, here, ladies and gentlemen, things are not working out. So what do? You split again. You split. Splitting a company into independent what here? Entities. Then we have spin-off. Very, very important in your past papers. Creating a new company by distributing shares to existing who? Shareholders. Have you ever seen a DJ somewhere? Yeah, these DJs, they have what we call disc jockeys. So these disc jockeys, they keep on, do they scratch them or something? But still they're moving on the same, isn't it? So whenever we talk about spin-off, they're spinning, You shall come and create a new company out of an existing company. So out of Safaricom as a company, you can very easily create a new company called what here, 𝐵𝑚𝑝esa? But if you are the shareholder, if you are a shareholder of Safaricom, and then they create a new company called 𝐵𝑚𝑝esa, and then they give 𝐵𝑚𝑝esa shares away to other, will you feel nice? I mean, 𝐵𝑚𝑝esa is the big thing here. So I can only accept this arrangement if in this case here, the 𝐵𝑚𝑝esa shares are spinned off. So under spin-off, you create a new company out of an existing company, but the new shares of this new company will be sold to who? Existing shareholders. That's a spin-off. So it is simply spinning off within, amongst the current what here? Shareholders. You think of it like spinning like that. This is very common in your past papers, and you should be able to go to your past papers, even type there, control find, and then you look for spin-off. They'll always ask you, AFM theory is 30%. And we said, if you pass just by knowing theory, as we don't care. What we want is you to do what you to get a PA? Or do you think we shall say this is a theory accountant? No, as we don't care. Get your 30% theory, get 10% from computations, pass and go. Do other things, isn't it? Then we have sell-off. So under sell-off, ladies and gentlemen, is where we have an outright sale of a division for cash. I don't like that definition. I don't like that definition for sell-off. I don't like that definition. That's a poor definition. So under a sell-off, we create what here, somebody? A new company from an existing company and sell all shares of new core to external stakeholders. To external stakeholders. To external stakeholders. So we create a new company from an existing company and sell all shares of the new company to external stakeholders. That is called a sell-off. So just like, for example, how the government was able to create Safaricom out of telecom. You know, Safaricom was inside telecom, isn't it? A department. So they created it, and then they were able to sell. But you see, they never sold everything, right? For a sell-off, if you create a new company from an existing company, and then you sell all the shares of the new company to external parties, we call it what here, somebody? Sell. And basically, we do this to improve liquidity. Improve liquidity. The online guys, are you able to follow? The online guys, are you able to follow? Great. Because I saw somebody saying you are disadvantaged. No, you shall never be disadvantaged. You shall never be disadvantaged. All right. Now, ladies and gentlemen, from there, we have what we call the equity carve out. Equity carve out. Now, listen. Now, for equity carve out, ladies and gentlemen, for equity carve out, this is what happens. So we have our A, and then we have A new, meaning that you have formed a new company from an existing company, right? Not that we are killing the old company will be there. Yeah. Remember, this exercise of creating new companies really is very, very good. New companies. Even at RCM, we create new companies from RCM. We have RCM publishers, we have RCM physical, RCM online, and they're different companies, but within the same mother. So you have a parent company. So in this particular case here, we have created A new out of A. If it is a carve out, at times we call it a carve out or an equity carve out. So if it is a carve out, what we shall do, this new company, we shall retain some shares. We retain majority of the shares. And then we sell the other shares, in this case here, to third parties. We carve out something for ourselves. So under a carve out, we shall create a new company, but dispose the shares of the new company partially. So in this case here, we are saying there, if you're writing, actually it's even written, I think this is written very well there. So we are told there, equity carve out, partial sale of a subsidiary through an initial public what year offering. Just like what they did with Safaricom from Telecom, because they never sold everything. They retained, the government retained something there. So under a carve out, don't forget the concept of us. We create a new company from an existing company, and sell some shares of the new company to external stakeholders. This is what you guys in AFR you call partial disposal. So they are calling it equity simply because you are selling what your shares. So that word should not scare you. That word should not scare you at all. No. KCC and new KCC, basically new KCC was all about rebranding, eh? Yeah, there is nothing like a new company that was formed there. It was just rebranding. It is like now what will be happening with this KPC, Kenya Pipeline, etc. Yeah, because you see the government is getting it from its structure, and then they are selling. But of course, at the end of the day, they don't sell everything. They will not sell everything. They won't sell everything. All right. We're almost finishing because I can see you guys are very tired. Where do you get tired that fast? I'm an old man and I have another class up to 10 p.m. We shall overcome, right? Liquidation. Liquidation is a very, very good form of restructuring where you close down unviable what year operations. Yeah, close them down. You can get some little amounts there, but you're closing them. Then we have strategic alliances where you form joint ventures or partnerships. Like the government of Kenya is so good with strategic alliances. We saw them having a strategic. So we have here strategic alliances. So we have Telecom Kenya. So we have the government here. Then we have, in this case here, strategic investor. From France, I don't know whether they changed. Yeah. So in this case here, they normally own this venture 50-50. It's Mr. 50%. So under strategic alliances, we are forming partnership with other companies to run a troubled company. Yeah. So the government says we can't run Kenya Railways ourselves. We don't have that expertise. And because they have already invested there, and they know that if they sell the shares, people are going to make a lot of noise outside here. What do? For Kenya Railways, they brought an Egyptian. So you give this guy what, you're 50%. But again, remember that strategic alliances don't work in Kenya. Look at Telecom. Has it ever made a profit? No. The other day, they made losses of 6 billion. When they make losses like this, what happens? Then automatically the government will be told, hey, you own 50% of this loss. So the government pumps in 3 billion, isn't it? So strategic alliances don't make, in this case here, lots of what here? Lots of profits for the government. The government is always better off doing what here? Selling. Yeah, the government should be able to privatize. So privatization is very, very good. Is it bad? The government should not be doing any business. The government should be there to ensure that there is order and what is secure in the country, isn't it? Or you want the government to be doing business? No, government should not be doing business. Even this Kenyatta National Hospital, all of them should be privatized. Ama mwananchi ataumia sana. But I mean, you're not suffering in form of taxes because those particular parastatals are eating money. All right. And they're not that efficient. All right. So long as, ladies and gentlemen, in this case here, this privatization is done in a very, very open way. Very open way, there is no problem. Like Safaricom to be privatized, the small percentage left here, it's a good thing. But let the government be very, very open by, in this case here, asking for what you be. Let them ask for bidders. There are so many other companies that can easily give more money than what this South African company. Even in this case here, bidders from yourselves who say that Kenyans cannot afford to buy these remaining shares. We can buy, isn't it? We can buy. All right. So privatization is very, very good. Government should not be doing business. So if it is about hospitals, privatize them, but ensure that 𝗙 is working. And these other guys in this case then who are not capable of paying for themselves, then 𝗙 will be able to do what here to rescue them like that. Problem with government, it's normally conflicted interest, isn't it? So somebody is calling me there, Kasongo agent. We shall overcome. So long as you understand the concept, that is the most important thing. Yes. So I'm only left with three things here. I finish and release you guys. So we have what we call management buyout and management buy-in. So we have here management buyout and management buy-in. Very confusing and very popular with your examiner. Very popular with your examiner. So I'm reading there that management buyout is purchase of a business by existing managers. Purchase of a business by existing managers. And then management buy-in, external managers now acquire control or purchase of a business by external managers. External managers like that. And I would want to explain. Now, ladies and gentlemen, assuming I'm one of the owners of RCM. Yeah, so I'm a director. I happen, for example, to be having here some shares. But you see, the college can easily get itself into problems. Within RCM, we have other managers here. So when we get ourselves into problems, these other managers could easily know that the people who are bringing problems are what you're there. They are misappropriating assets of the company. Maybe they're not paying lecturers. Maybe, of course, RCM, we're very good at that. So these other managers now can, because they're existing, they can say, let us buy out this there. There you go. So that becomes a management buy what year out. Remember, when we have existing managers within the company, yeah, buying the company itself, so it will be a management buy what year? Buy out. Because those managers are not coming from outside. Those managers are where? In the company. Yeah. So when they are in here and they are buying us as we are going, so it becomes what here? Somebody management buy out. Purchase of a business by existing who? Managers. That is a management buy out. Look at the late 𝗃𝐶𝐵. This gentleman was very, very good at targeting those inferior companies which needed to be bought. Centum, if you remember the business model of Centum. Yeah. So in this case here, 𝗃𝐶𝐵 was so much known in doing what we call management buy what? Buy in. So they would work as expert managers from outside. They buy. So it becomes a management buy in. So management buy in, it's purchase of a business by what? Here, somebody. External managers. So you need to know how to differentiate. And a management buy in, I can see external experts working into RCM here, they buy RCM. But if it's a management buy out, it is existing managers here who are buying as a existing managers. So you need to know how to differentiate. So when they come and bring the concept of leveraged buyout, when they talk of leveraged buyout, what comes to your mind? Debt is being used. Now these guys who are coming in to buy the college, they are broke. They must get, in this case here, what year? Debt from a bank. So what they'll tell us is that we give them what year? Title D, so that they can secure, they get security. So it's called a leveraged. So we have here leveraged. You can see there, and the leveraged. So when I come in our next class, we shall be able to look at many past paper questions out of this. Leveraged buyout, acquisition financed largely by what year? By debt. Just acquisition financed by debt. So it has been great, ladies and gentlemen, hosting you this evening. I'm looking forward to meeting you again. Remember, we need to introduce a third session. Yeah, for even if it's just 1 hour over the weekend. Can we discuss about that today? And you don't have to come here over the weekend. You can also be online students over the weekend for AFM. So AMA, we know it's 6 p.m., 6 p.m. So AFM, we do it what time? Just 1 hour. Just to come and remember these weekend classes, they're basically classes for tackling past paper questions, revision. So Sunday, what time? Because I know Saturday you have classes from 6 to 8. So then Sunday, what time? Just 1 hour after church, 1 hour. 5 a.m., I'm open. I'm ball. 5 to 6. My Saturday is easy. Before 2, Great. So Saturday from Sunday 5 to 9 in the morning, they will say they are going to church. Is it something you guys can discuss on your own and then you tell me? You can tell me through this great lady called Marion. So the online guys, what are they saying? What is the very best time for them on Sunday? Let me see here. Motivation here. There are 1,000. Somebody, yeah. So please, yeah. That's very, very important. Let me get my phone. As you guys discuss about that Sunday, isn't it? Please remember, assignments ni compulsory na unaifanya immediately. Immediately. So nitawapatia moja peke yake ya December 2021. Question number 3. So unaifanya immediately, unatuma kwa WhatsApp group yetu. WhatsApp group meta jina gani? AFM, hiyo sitajua. Unaita AFM Ninjas. Hivyo ndio mimi nitajua. Kama ina jina ninja staki, hiyo sitajua. Yeah. Sasa la semester ilikuwa MA Ninjas. Yeah. Because sisi ni watu wa kujituma. All right. It is PM. Thank you so much. I have another class starting at 8:30. What can you prepare?